Hello, everyone. My name's Will, and it's my pleasure to be at the Australian Conference of Economists. Today, what I'll be talking about is fat taxes and the economy. So, let's begin with what is a fat tax. A fat tax is a tax that has been proposed and implemented in many countries across the globe. Essentially, it's a tax that is associated with foods that are considered unhealthy. For example, foods that are containing high levels of salt, sugar, or saturated fats. The idea is to deter consumers from purchasing these unhealthy products and instead encourage the purchasing of more healthy ones. There's been much debate about the actual health benefits as well as the long-term economic benefits a fat tax can provide. So, how can a fat tax influence consumer and producer surplus? So, consumer surplus can be described as the gap between the price consumers have a willingness to pay for a good or service and the actual price they will have to pay to purchase it. For example, say you want to buy a burger for $20, but the cheapest you can find on a food delivery app is actually $15. In this scenario, your consumer surplus would then be $5. Now you can see that in the green box there. So you wanted the burger for $20, equilibrium is at $15, and so you have a consumer surplus of $5. Now, producer surplus refers to the difference between the monetary amount an individual, or in most cases a business, would be willing to accept for a given quantity of goods or services versus how much they can actually get by selling it at market price. So, using the burger example, say you're looking to sell your burgers at $15. However, someone has already offered you $20 for it. Your producer surplus would then be $5, which you can see in the green box on the graph there as well. Keep in mind, these examples are only to get my point across. They're not the best in the world. So consumer producer welfare is the sum of these two figures. And how taxes impact products and or services is by increasing prices. That is, so long as the company does not want to face the cost of the tax. As a result, the consumer surplus for said products will decrease and therefore lower the quantity demanded because consumers don't want to pay more for the food items. This lowers the demand curve, and furthermore, a fat tax can also reduce the quantity supplied by producers as raw materials that will fall into the taxable category can be taxed in purchasing processes and production. This can then price many consumers and producers out of the market. Let's say a tax of $5 is put on the $15 burger, for example, from before. In this case, the consumer surplus will then be reduced by $15, and so will the producer surplus. And overall, the consumer and producer welfare will be reduced by $10. So a fat tax will become the loss of consumer and producer surplus that occurs when the market is not at equilibrium. Overall, the deadweight loss will reduce the consumer and producer welfare in those taxed markets. So, what are the implications regarding the macroeconomy? Two key components to address are aggregate demand and aggregate supply. Aggregate demand is used when describing macroeconomies and outlines the total demand for goods and services produced domestically in an economy. In other words, it is the sum of all individual demand curves from different sectors in the economy. Typically, taxes will reduce the aggregate demand because people's personal disposable income decreases with raised prices. So aggregate supply is the total supply of goods and services produced within an economy at a given overall price level in a designated time frame. So in other words, the sum of all goods and services all firms in a national economy plan on selling during a specific period. Depending on how they're implemented, taxes can have positive and negative impacts on aggregate supply. So a reduction in taxes can increase the profit margin and therefore for businesses and encourage investment into expansion and therefore increase the aggregate supply in the economy overall. However, tax increases can increase the cost of production for business at any stage in the production line. So this then restricts our business's ability to spend money, of course, and therefore reduces aggregate supply. So using an aggregate demand and aggregate supply model, how can we determine if a fat tax that will increase people's health can actually have any long-term benefits for the economy? So let's have a look at this. A fat tax will undoubtedly cause major long-term benefits and consequences implemented. Let's start with the good. So people will be encouraged to eat healthier food, therefore increasing health and reducing strain on hospitals. The Primary benefit, however, is that people's disposable income increases as they're not paying for taxed unhealthy foods and they're having less frequent health complications and as a result, less frequent health costs. Another gain from a fat tax will be the increased revenue that the government receives. So the tax the government receives enables it to direct funding into other areas of need, such as cost of living relief, which is very much an issue in Australia at the moment. Essentially, the idea is that the people will benefit from the tax through infrastructure and improvements to quality of life. On the other hand, however, it can be argued that a fat tax will actually be regressive, primarily because it is believed low-income groups tend to consume more unhealthy products and possibly don't have the resources available to switch to healthier options. This can perpetuate a potential obesity crisis, especially when there is inflation in other areas of the economy. This then extends to the macroeconomies of the health industry as the aggregate demand for health services will rise again. And so finally, how can we actually look at an empirical econometric model to assess the health and economic benefits and consequences of a fat tax? So empirical models verify qualitative predictions made using theoretical models and convert them to precise numerical outcomes. So for a better picture, a theoretical model on the consumption of food once a fat tax is implemented would generally attempt to explain the relationship between the taxes imposed and the consumption of these products in a particular time frame after they've been imposed. Through this method, you are able to analyze the data and make predictions on how effective a fat tax may be. Overall, an empirical model is essential to understanding the right way to implementing a fat tax. So, to round everything up, I would just like to thank everyone for their time today. It's been a great experience putting all this work together for the ACE, and I look forward to working with all of you in the future. Have a great day.